Yes, hello. Welcome to our second lecture on in this essential finance for managers and individuals. I hope you enjoyed the first one, and now let us go. Come on, let's go. Well done. We are now on a roll. So let's see what happens next. The aim of this one is to discuss a little bit about the financial statement and management accounting again, so that you can remember what we've just done and the uses of that information. What do people use financial information for? And also, who are the users of financial data? That's what we will be discussing today. So I know there's curiosity. People have been asking me these questions, so I thought I'd better address this, because mainly this is about the management of finance and accounting for managers. They are not normally involved in bookkeeping, but I get this question all the time. What is bookkeeping and what is the difference between bookkeeping and accounting? Okay, so let's tackle that once and for all. Okay, bookkeeping is actually how we process information. We gather information such as invoices and sales, and we process them through the system. This is what happens by processing that information into a system. We're now able to extract that information to make decisions in accounting. So bookkeeping really is an essential part of accounting, but it is that point where you are separating invoices and deciding whether is this an expense, is this a capital, is this, and you do that, and then you process them through the system. The same thing with the sales invoices. You raise those invoices and then you categorize them. So bookkeeping is that data entry level, and it's an essential part of accounting, because without the information there, you will not be able to use that information to analyze, to decide, to report. So that's bookkeeping. Okay, you remember we said what accounting is from lecture 1 is to really to identify and measure and be able to make decisions about information, but also to report on that information. Also remember the two different types of accounting, which is the financial management and the breakdown as well. I'm sure you remember this from the first lecture, but it's just a reminder just in case. Now let's get down to the people who actually use informations, the owners of the business sometimes, because they're not there. If you have shares in a very large company like Walmart or Apple or Amazon, the shareholders don't run the companies, the board of directors run that. So they will need information as to how the organization is doing. Managers also need that. Lenders such as banks, suppliers supplying information, investment analysts and journalists who report, a whole bunch of people, government and competitors, including consumers as well, will need that information so that they can decide how the organization is performing. It also allows for responsibility for people to be able to decide how well the organization is doing, but also, especially for large companies that have gone to the stock market to collect money from shareholders, they need to be held responsible for that. So that's one of the things. Another part of this is this: information can be completely useless depending on how we use it. So there are rules as to how important information, especially financial information, needs to be. Yeah, it needs to be relevant. It needs to have good quality, because if we process information that is really bad, then we're going to get back really terrible information. It needs to be on time. There's no point in reporting what happened 10 years ago now. So it needs to be, you need to be able to compare. So all of those things are the reasons why accounting rules are very strict, so that people do not manipulate those particular information. And therefore, it's important that this is taken into context. And also, there's something called materiality, which is it needs to be a big enough number to affect things. So somebody stealing, £10 or something from a big company, it's not big enough to warrant a change in the overall impact. It's not big enough to have any impact. Accountants call that materiality level. That is not material. It's not that a big issue. So we cannot be picking on every single item, because then the information becomes useless and we get bogged down in details as well. So look at some aspects of accounting information. We need to be able to identify them. We need to be able to record, analyze, and report on them. So those are the elements of financial information. There's a whole lot of information, some of them absolutely different and critical. For example, data, they might want every single data of everybody, but in accounting information, it's slightly different as to what it is we'll classify as accounting information. Okay, so let's look again at some of the other aspects of this. Who are the users of information and what do they use the information for? Sometimes people, investors, use information for future earnings or dividends they're going to get. They use that for potential capital gains. Liquidity is important, so how much money is going to have. The ability to pay interest back, all of that information are the things that people need those particular financial information from. Now, I mentioned earlier on about management accounting and financial accounting. To let us understand what it is, this particular table up here shows us the differences between them. You can see one is for general purposes, the other one is specific and can vary between companies. So management accounting can be specific to organizations and it can change. It's often very detailed because they make it to, they use that information to make decisions. Some is definitely not regulated because every company can have their own type of decision-making processes. It's really required by managers, and sometimes it's actually used to project the future. So those are the kind of things that they use management information for. Whereas financial accounting is to report back in general. It's subject to regulation because we don't want two different companies to be reporting different things that could confuse the general public as well as the investors, and it could also be used to manipulate something. Normally annually or biannually for large companies. In the US, it's sometimes quarterly. The information being used is actually historic, so it's in the past. They are reporting about what happened in the last few months, last year, last financial year, and therefore it's really about the past. And therefore, those information needs to be very valuable. They need to be verifiable. They need to be absolutely sure about them because otherwise people will manipulate this kind of information. Okay, so what are the changes within business environment? The world is completely changed. The sophistication of customers, people can make comparisons. They understand where to buy things cheaper. They can go to Amazon. They can go to their local shops. They can check everything. They can go to comparison, the comparison website to make comparisons. So they're really sophisticated. So financial information also needs to be. That is a global economy. Everybody relies on everybody else. You can order things from the other end of the world and compare them to what is here, what is happening here. Technology is changing so quickly that every so many months things are changing. There is deregulation in the local market. All of these things are putting pressures on organizations. And I'm not sure about you, but where we live, there have been several companies who have gone out of business, especially the ones on the high street. So really competitive market. And a lot of that competition is coming from people in other countries, or people who work from home, or people who work from the internet. Okay, well done. That is the end of the second lecture. You have done absolutely well. I'm not sure how you're feeling, but I hope you're feeling really good. You should be proud of yourself. And I hope you can go back and recollect what it is that we have done. Thank you very much. Well done.